You're about to discover why 90% of traders fail, and it has nothing to do with market analysis, chart patterns, or economic indicators. The brutal truth is this: most traders violate one fundamental rule that Jesse Livermore called the difference between speculation and financial suicide. Break this rule, and you'll join the masses who lose everything. Master it, and you'll think like the man who made 100 million in 1929. Here's the counterintuitive reality that will shake your trading foundation. The best trade you'll ever make isn't a winning position. It's the small loss you accept immediately, not the home run everyone chases. That 200 loss you cut a day prevents the 200 loss you cut a day prevents 20,000. Catastrophe you'd fight for months. The market punishes hesitation at a compound rate that destroys accounts and dreams. Amateur traders negotiate with losses, widen stops, and give positions room to breathe. They confuse hope with strategy. Professional traders cut mechanically, size positions so stops feel painless, and only add capital after market confirmation. Same charts, completely different financial outcomes. This identity gap separates the survivors from the casualties in every market cycle. Livermore learned this golden rule through spectacular failures that cost him millions. He went bankrupt 3 times before mastering the principle that would define his legendary career. Each bankruptcy taught him that while market conditions change constantly, human psychology remains predictably destructive. The same emotional patterns that destroyed accounts in 1907 are destroying them today. What is this golden rule? It's not simply about stop losses, though that's crucial. It's not just about position sizing, though that's essential. It's something deeper, a fundamental shift in how you view every trade, every decision, every moment in the market. This rule transforms trading from gambling into systematic wealth building. The rule begins with understanding that your greatest power isn't your ability to act, but your discipline to wait. Most traders think success comes from finding perfect entries or predicting market direction. They're wrong. Success comes from protecting capital while the market reveals its true intentions. In our next chapter, we'll explore the patience paradox that made Livermore rich while destroying his competitors who couldn't sit still. Here's the first piece of Livermore's golden rule that will revolutionize your trading. It was never my thinking that made me money, but my sitting tight. Got that? My sitting tight. This statement contains a paradox that destroys amateur accounts daily. Most traders believe constant action equals progress, yet the opposite drives sustainable wealth. The amateur feels compelled to trade constantly. Markets are open. Opportunities seem everywhere, so they must be doing something, right? This hyperactivity is financial poison. Livermore discovered his greatest profits came not from brilliant entries, but from his ability to do absolutely nothing once positioned correctly in confirmed trends. Picture this scenario. You identify a stock breaking out at 50. The amateur buys immediately, fearing they'll miss the move. Price drops to 50. The amateur buys immediately, fearing they all miss the move. Price drops to 48 on light volume. Normal pullback behavior. Panic sets in. They sell at 47.50, taking a loss. The stock recovers to 47.50, taking a loss. The stock recovers to 52, then 65. The amateur buys back in at 65. The amateur buys back in at 55, feeling smart. It drops to $51. Panic again. This cycle destroys accounts through constant whipsaws. Livermore's approach was surgical. He'd identify the same 50 breakout but wait for confirmation. Volume expansion, successful retest off the breakout level, or what are called pivotal points. Only then would he commit capital. When price dropped to 50 breakout but wait for confirmation. Volume expansion, successful retest off the breakout level, or what are called pivotal points. Only then would he commit capital. When price dropped to 48, he'd do nothing, understanding that short-term noise means nothing if the fundamental thesis remains intact. When the stock reached $75, he was still holding his original position. Professional protocol is clear. Waiting isn't passive, it's strategic positioning. Cash is a position. Patience is a position. The amateur confuses activity with progress, but the professional understands that premature action destroys more accounts than market crashes. Your edge isn't speed, it's selectivity. The big money is not in the buying and selling, but in the waiting. This patience requires enduring psychological discomfort without action. The market will test your conviction with every tick against you. Most traders can't handle this mental pressure, so they act prematurely and destroy their edge. But patience alone isn't enough. Even perfect waiting becomes worthless if you don't know when to cut losses fast. That's where most traders commit the unforgivable sin, turning manageable scratches into account-killing catastrophes. Here's where Livermore's golden rule becomes brutally practical. Professionals cut losses fast and without debate. Amateurs negotiate, hope, and rationalize. That negotiation is where accounts die a slow, painful death. This single decision point separates market survivors from casualties in every trading generation. The deadly amateur pattern unfolds predictably every time. You buy a stock at 50, expecting a Movado 50, expecting a Movado 60. It drops to 48. Your inner voice whispers, "It's just a pullback. I'll give it room." Price hits 48. Your inner voice whispers, "It's just a pullback. Will give it room." Price hits 46. Now the voice gets louder. "I'll average down. My cost basis improves." You add more shares, doubling your exposure to a deteriorating position. Price drops to 43. Desperation sets in. Ithasto bounce from here. By the time you finally surrender at 43, desperation sets in. Ithasto bounce from here. By the time you finally surrender at 40, a manageable 4% loss has become a devastating 20% catastrophe. This is how accounts are systematically destroyed. Livermore fell into this exact trap with cotton futures in 1907. He was right about the long-term direction but wrong about timing. His refusal to take small losses early led to margin calls and eventual bankruptcy. This painful lesson taught him that the market's opinion always trumps personal conviction, regardless of how well-researched the thesis might be. Your analysis means nothing against the tape's verdict. The first loss protocol is non-negotiable. Step 1. Predefine your risk before entry, risking 0.5% to 1% of total capital per trade, never more. Step 2. Place stops where your idea is technically invalidated, not where it feels comfortable. Step 3. Never add to losing positions, ever. If you want more exposure, you need confirmation and higher prices. Step 4. When stopped out, stand down for at least 2 bars to clear emotional interference. The mathematics of survival are stark. On a 100,000 account risking on 100,000, account risking $15,000, annoying but survivable. With averaging down habits, those same 5 trades can cost $15,000 to $15,000 to $25,000. Now fear controls every decision, and rational thinking becomes impossible. Never average down. You're not rescuing a trade, you're drowning your discipline. The first loss is the best loss. The market is never wrong, your position size is. These aren't clever sayings, they're survival principles that separate professionals from casualties. Cutting losses protects your capital, but how do you re-enter without chasing? The answer lies in understanding pivotal points and market confirmation, where patience transforms into precision. Now we reach the sophisticated component of Livermore's golden rule, how to scale into winning positions without giving back profits. Amateurs risk everything at entry, then freeze when they should add. Professionals start small, let the market prove them right, then pyramid into strength. This reversal of conventional thinking separates consistent winners from occasional lucky streaks. Livermore never held positions based on hope or personal conviction alone. He demanded that the market validate his thesis through price action at what he called pivotal points, critical levels where stocks either break into new trends or fail and reverse. Only after this confirmation would he exercise patience or add to positions. The market had to earn his trust through performance, not promises. In 1925, Livermore initiated a wheat futures position expecting a major bull market. The initial position moved slightly against him, but then wheat began showing strength at key support levels. Volume expanded on rallies, and price held above previous resistance. The tape was confirming his thesis through action, not hope. He added to his position and sat tight through months of volatility. The eventual profit exceeded $3 million in 1920s dollars, a fortune built through systematic scaling rather than lucky timing. The 1-1-2 pyramiding protocol follows strict mathematics. Start with 1% risk at the confirmation point. Add equal size after achieving 1 unit of profit, raising stops to break even. Double the size after higher pivot breaks, trailing stops under structure. The critical rule: never add below your average price or below the last higher low. This ensures you're always adding to strength, never weakness. Here's the practical application on a 100,000 account. You buy 900 shares at 100,000 account. You buy 900 shares at 41 with a 49.90 stop, risking 49.90 stop, risking 990. Price runs to 52.10, delivering your first unit off profit. Add 900 shares, raising stops to break even. En nieuw pivot form staat 52.9, delivering your first unit of profit. Add 900 shares, raising stops to break even. En nieuw pivot form staat 53. Add 1 or 800 shares, trailing stops under 52.1. Total position 3, 600 shares with risk still kept at your original 52.20. Total position 3, 600 shares with risk still kept at your original $1,000. This is how small positions become life-changing wealth. Proper position sizing creates psychological advantages that most traders never experience. When your survival isn't threatened by individual trades, you make rational decisions instead of emotional ones. You can follow your system instead of your fears, creating the mental clarity that separates professionals from amateurs. Be small when you're wrong. Be big when you're right. Add to winners. Cut losers. Everything else is noise that distracts from wealth building. This systematic approach sounds perfect, but there's one final trap that destroys even disciplined traders: emotional drift during winning and losing streaks. Here's Jesse Livermore's complete golden rule that you must never break. Always protect your capital above all else. This is the hidden principle I promised in Chapter 1, the difference between speculation and financial suicide. Without capital, your edge, your analysis, and your market opinions become worthless. The amateur chases gains while the professional defends capital first, letting profits take care of themselves naturally. Livermore's repeated bankruptcies hammered this lesson into his consciousness. Without money, the game is over. You can't trade if you have no capital left. This seems obvious, yet most traders focus obsessively on making money while ignoring the primary job of keeping it. The professional understands that survival is the gateway to compounding wealth, while destruction happens in a single catastrophic decision. The Complete Protection Protocol integrates everything we've discussed under one umbrella. Never risk more than 2% to 3% of total capital in a single day across all positions. Each individual trade risks 0.5% to 1% maximum, allowing for multiple attempts and inevitable mistakes. Implement the two-strike rule. After 2 consecutive losses or 2 rule violations, stop trading for 24 hours to clear emotional interference. Recognize that psychological energy is finite. Guard it as carefully as financial capital, because emotional exhaustion leads to catastrophic decisions. The mathematics prove this approach works. Risk 1% per trade with a 60% win rate and 3.1 reward to risk ratio, and you'll compound wealth steadily. 5 consecutive 1% losses on a 100,000 account cost 100,000 was an account cost $5,000. Annoying but survivable. The key is surviving inevitable losing streaks while maximizing winning streaks through patient pyramiding. Consistency beats brilliance in wealth building. Every component serves capital protection. Patience preserves capital from premature entries. Fast loss cutting prevents small mistakes from becoming large ones. Confirmation ensures you're not fighting market direction. Pyramiding compounds gains from validated positions, and position sizing ensures no single trade can destroy your account. Livermore's greatest period came after 1910, when he fully internalized this rule, enabling him to profit enormously from the 1929 crash while others were destroyed. Your actionable recap centers on 5 pillars. Cut losses fast, size by risk at 0.5% to 1% per trade, wait for confirmation, pyramid into strength, and protect capital daily through strict limits. The market will always be there tomorrow. Your capital might not be if you don't defend it today. If this framework resonates, our next lesson on reading pivotal points and tape action will turn patience into precision and transform good traders into great ones. The final piece of Livermore's golden rule addresses the psychological trap that destroys even disciplined traders: emotional drift during winning and losing streaks. You can master patience, cut losses fast, and pyramid correctly, yet still fail if you can't manage the emotional extremes that come with extended periods of success or failure. This is where most systematic traders abandon their edge just before it pays off. During winning streaks, overconfidence creeps in like silent poison. You start believing you've cracked the market's code. Position sizes gradually increase beyond your rules because risk management feels unnecessary when everything's working. You begin taking marginal setups that you'd normally pass, convinced your hot streak makes any trade profitable. This emotional drift transforms disciplined professionals back into reckless amateurs. Livermore experienced this repeatedly, watching massive profits evaporate because success bred carelessness. Losing streaks create the opposite but equally destructive pattern. Doubt replaces confidence, making you second-guess every signal, even the highest probability setups. Position sizes shrink below optimal levels, or worse, you stop trading entirely just as your edge is about to reassert itself. The market's random nature ensures that even perfect systems experience extended drawdowns, but emotional traders interpret normal variance as system failure. The streak management protocol requires mechanical adherence to predetermined rules regardless of recent results. During winning streaks, maintain exact position sizing and risk parameters. Write down your rules when thinking clearly and refer to them when emotions run hot. During losing streaks, continue taking all qualified setups with proper sizing. Track statistics over meaningful sample sizes before making system adjustments. Livermore's 1929 triumph illustrates perfect emotional control. While others panicked during the crash, he maintained his systematic approach, shorting into strength and covering into weakness. His 100 million profit came not from predicting the crash, but from following his rules while others abandoned theirs. He treated each trade as an independent event, immune to the emotional chaos surrounding him. The complete golden rule integrates all components: protect capital through proper position sizing, cut losses immediately without negotiation, wait patiently for confirmation at pivotal points, pyramid systematically into validated moves, and maintain emotional discipline through all market conditions. These aren't separate techniques. They're interconnected principles that only work when applied together consistently. Your trading success depends on viewing each component as essential to the whole, creating the systematic approach that separates the elite few from the struggling masses.